Are you comfortable with projecting a 20 times earnings ratio?
You know, I think valuation, it's important. Valuation is never a determinant of what stocks do over the course of the next year. I'm not worried about valuations at this point in the cycle. Economic growth is accelerating. Stocks are largely being supported by better earnings growth. Stocks should be more expensive than average right now. You know, over the next 10 years, this high of a valuation means returns are going to be below average, maybe just 5 or 6%. That's important to keep in mind. But over the next year, we expect solid rates of return on the stock market. Remember, PEs just don't determine what stocks are going to do in the year ahead.
The curve keeps getting flatter and flatter and flatter. Weave that in to the Fed finally not reinvesting 100% of its securities.
Well, I'm going to look a little longer term. I'm not sure we have 4 years for the Fed to sort of normalize its balance sheet. I think what the yield curve is telling us, these flatter and flatter yield curve, is that a recession is coming. Oh, it's not probably in the next year. Certainly, yield curve isn't predicting that. But it's probably not 4 or 5 years away either. I'm not sure the Fed's going to get to its target level of where it would like to see its balance sheet before it has to think about puffing it back up again as we enter the next recession, maybe 2 or 3 years from now. That's something to keep in mind. Inflation is going to be a critical issue for the market in 2018, maybe as much as politics dominated 2017's discussion.